So a friend of mine has a joke. I don't know whether it makes sense now, but he's a very seasoned investor. He says, and as a trained actuary, you believe in data. So his biggest argument has always been all his life. He believes in two things, God and data. And when we were having this debate, I said, I do believe in God and data until capital shows up. Because real estate is all about capital. When you listen to all these investors in the world, you listen to these guys, they'll talk about everything. They'll say, it all began with an idea. Everyone says, I was under a tree like Einstein and this happened. No, it all began with capital. One of the questions Paul asked yesterday was, where are the people that actually allocate capital to REITs? Where are they? What are they looking at? Some of these structures that we're talking about, ESG, all these de-risking mechanisms, they're good. Maybe they're good for us as promoters and the people developing the product, but are they good for the people allocating capital? And today we'll try and demystify, have we been running ahead of ourselves as promoters, and what are they looking at? So Tim, the pensions industry is very notorious. They are like a cartel. The 7 of you mega fund managers, you decide which deal to allocate to, when to allocate. But the biggest questions I wanted to ask you today is, how can the pensions industry, maybe by extension the insurance industry, how can we as REIT issuers, as promoters of products, I know you do Bartian, but you've had to pivot from being a fund manager to your specialist as a real estate investor. Wearing that dual hat, I am in a fund management firm, but I do real estate. What do we need to do better to get capital allocated to REITs here? That's the first question. The second question is, are we as promoters looking at the wrong thing when we are structuring these products? And how can we align ourselves between you as the allocator and owner of capital to ourselves? Because we may be structuring deals and thinking we have the right product, but we don't have the right money chasing that product. How do we do that?
Once again, good afternoon. Yeah, clearly time has gone. Yeah, it's good afternoon. I think one of the advantages you get being on a panel at the tail end of a conference is you simply get to repeat what everyone has said, but you affirm it to cement, right? I think the question Matthew is asking is really, and we get this question a lot, so it's a question we answer a lot. What are the barriers in terms of just getting capital allocated? The big elephant in the room remains and has remained and will remain returns, right? It's just what it is. And I think I'd like to go a bit, let me just spend a bit more time, because also Matthew has given me a hard time on this particular question in terms of return. At a very fundamental level, when you're looking at emerging markets and trying to compare them to developed markets, the reality is, on a risk-adjusted basis, alternative instruments sell themselves without the need to sell them, right? In markets like ours, we know government securities and where they're trending in terms of yield. So when you're trying to sell such a very simple basic concept to a trustee, and you're telling them, these are the people who oversee these boards, remove your 1 billion bond that's earning you 130 million per year in coupon, and put it in an investment that will give you 60 million per annum. But then if you wait patiently, you're losing how much? That's like 70 million per annum. But if you wait patiently over the long haul, you'll get a concept called, because these are not technical people, the IRR, or the total compounded return in the long haul, will be very attractive. So over time, you'll recover the initial loss of capital significantly. So that has not been an easy, that's been one great hurdle. And an easy way to look at it is just think about your money market. If today you have two issuers, someone is giving you a 4% and another party is doing 15%, you all know where you'd place your cash. So at a trustee level, they take it in a very simple way, and that's one key hurdle. But if you look at it in an absolute sense, Matthew, I think we're jumping the barrier. I don't think we're at a place where I'd like to say these are the barriers and we're having a very hard time. I think we are jumping the barrier. And I say that I said I'll reference a lot of points that were already made during the conference. You had Raghav yesterday. It's a question they face. I also have a very hard time raising capital. I think if you know my AUM at the moment, you get what I mean. The other fund managers with products, if you look at their AUM size, I think you guys have moved quite significantly, but it tells you we are all dealing with that same challenge. It's not just people not within the fund management fraternity. Now, there's a good question you had asked me on the side regarding how do we look at structure and viability? Because at the end of the day, some products are not built around an annualized yield. The reality is there's a capital gain realized over a period of time. And so it has to be an IRR. You have to look at the total return of the product over a long period of time. The challenge we've been having with that, we've tried to push pension schemes to understand the big picture. Because if you look at some of your sectors, in student housing, I'm seeing a lot of players in the room, affordable housing, those are sectors with great social impact. And you really need pension capital with its profile participating in those segments. So we've tried to make an argument for, can you have a social capital allocation and think through it differently? We think actuaries also need to help us in terms of lobbying on that particular mindset. Some schemes get it, others are still averse because they're thinking, why should we lead in experimentation? Why don't I forsake my 18% total return, let the product move in for a bit, say 5 years, then I'll come in when it's about 15%. But at least I've faced that a lot. I know like 10 clients waiting to see track record and so on. So those are the challenges we face, but just as I conclude, I think thinking about Raghav's comment, whether we like it or not, looking at the liquidity and where that liquidity curve is going, like the amount of money that will be there in circulation, at the end of the day, all that money cannot be parked in government securities. It will have to go somewhere. And the more it is, there'll be downward pressure on government securities. So it will make also alternatives more attractive. So we're not there yet. That's the hurdle that we can't give a very simplistic answer to, but we are very confident that we're making significant strides. Looking back 10 years, 15 years when Ken and Jeff were here at the helm, I think we're making significant strides and we can see that. The second hurdle, and this is why I said we're jumping the barrier, is institutionalization. Initially, you had pension schemes doing direct, and I think Paul, you mentioned that. This is not, property is very specialized. A lot of them went direct and they messed up. So there's a lot of legacy issues on the asset class. However, that's due to them having gone in directly without properly understanding. Yes, we like property. A lot of Kenyans do it, or maybe Africans. But at the end of the day, at scale, it needs a specialized party that really understands what they're doing. So we are also in a phase where I feel we're dealing with that remnant of those legacy issues. And we've seen a lot of institutional players, yourselves and so many other people in the room. I think the more players we have, the more issues we have, the more track records we can pile up in the industry, then inevitably it becomes much clearer to a lot of promoters that indirect portfolios, these are the returns against direct portfolios. And I think with time, we'll see a tilt towards indirect allocations. Thank you.
Well, you've had the fund manager, developer, operator now, talking about what they look at. Are we structuring our products and our REITs for return? For sure, return is a key metric, absolutely. But is it the main driver? You've spoken about social good, you've spoken about impact, you've spoken about everything. And here we are very big proponents. I am a very big proponent of domestic capital. And in my view, that domestic capital should lead the way because real estate, in my view, is a local currency play. And if domestic capital gets that opportunity to lead the way, then concessional capital or commercial capital then will follow. But then as we structure our products team, you having allocated across East Africa, Timothy, as CPF and as everything, what do we need to do to get the other view of allocators? You've sat in many places as as owner of capital, and also allocator of capital to these deals, and you screen maybe 10, 15 deals a week, and you look at them and real estate. But what we need to do really to mobilize good capital locally, because a lot of people here are breaking their backs, they're structuring good products, they're doing REITs, they're going through the expensive ESG stuff, right? Like I said yesterday, it's very expensive and we can't see that ROI. But what we need to do from an allocator of capital as well and an owner of capital to mobilize more local capital into this real estate, into REITs, into such products. Because as you say, and CPF, I think you sit on a lot of real estate. So you've structured your new REITs and your new products around the fact that you want to, securitize your real estate. But then how then do we mobilize local capital to see beyond this return and then, propel, local developers and promoters who are really, really doing a lot of good stuff that I've seen in the deal room?
Thank you, Matthew. It's a mouthful. I think I'll begin by introducing just CPF and some of the things that we have done in the REITs segment. Having been the first pension scheme to set up a REIT, the Lab Trust Imara REIT, valued at about 7 billion shillings. We are also investors in Econ, both in the bonds and the IREIT and the D-REIT. We're also investors in the ALP, the latest baby in town, ALP. At the same time, in the pipeline, like you mentioned, we have about 3 REITs that are at various stages of completion. The first one being we're in the race of being the first. You like being the first, you noticed. The first Islamic REIT in Kenya. I know there are several in the pipeline, but we hope to be the first ones. And just to finish with what you said, I saw an advert in the papers the other day whereby one of the pension schemes was trying to was auctioning their properties. I know you know who I'm talking about. I don't know if it was mentioned during the last sessions, but at SPF, once we saw that, we were like, damn, I wish it was our problem, because what we could have done is easily package all those properties into a REIT, and then list that REIT, and of course, offload it. Of course, the first thing will be is you'll be compliant with RBA. The second thing is that now you'll have enough time to offload those units with no pressure, as opposed to doing an auction. So that shows you the sort of opportunities that are there. In terms of the environment within which you're operating in, I'd like to be very, very frank that the regulations are very, can I say, supportive to the REITs market. I remember when you tried to do the Lab Trust IREIT, there's a regulation that says you must have 7 investors, something like that. We didn't want to get many investors because of the issues of free float and what happened to the first REIT in Kenya when you have so much free float. So we went to the regulator, CMA, and they managed to waive that regulation for us. Then we went to RBA and we told them we want to be compliant to the regulations, Table G, and we want to do this by putting and packaging all our properties, the rent income yielding properties into a REIT. They didn't resist, because we were saying how can a pension scheme be an issuer? That was the key problem, but they were very supportive. So in the side of regulations, I think we are sitting very well. The only challenge that we came into we intended to set up a REIT, or rather we are setting up a REIT in Rwanda, Kigali, for one of the properties in the hospitality industry. So we intended to put in some substantial amount of investment there. However, the regulations, as they currently stand, demand that you put for only REITs that are registered in Kenya. You can't do REITs in East Africa. So that was a big challenge, although having discussions with the regulator, I think they are looking into that, and we should be able to have that one amended to have the entire East Africa being eligible for investment by pension schemes as part of the free capital movement across East Africa that was envisioned in the ESC communities. Some of the other challenges we are having as pension schemes is the trustees. In Kenya, the law says the trustees only have 2 terms of 5 years or 3 years, can't remember, and then they go. By the time you have localized the trustees on what is a REIT, they've gone, they've been removed. New trustees come in. You have to start from the scratch and telling them what is a REIT in the first place. So that's a very big challenge, and I'm seeing a team, my namesake, they're smiling because he knows. That's what we encounter as fund managers. One of the proposals we are bringing to RBA is that they would think about having a corporate trustee sit in the panel, so that corporate trustee is not eligible for those elections and some of those political things that may interfere with the appointment of a trustee. And that person will have, let's say, 10-year tenure. Then they can be able to make those decisions which require a skill. At the same time, we need to look at the returns. Tim mentioned that one. Most of the REITs that are listed do something to do with 7%, 6%. When you have a treasury bond, interest-free, at 12%, it's a no-brainer, really. Yeah, and it requires smart money to do the IRR computation of 20 or so years to really recognize that the long-term impact of investing in a REIT surpasses that 12% interest-free from a bond. What then could investors do? At the moment, I can see 2 or 3, 4 investors here who we are currently in talks, and we are thinking instead of them setting up their REITs, it's very expensive, I can tell you that. Instead of setting up their own REITs, we could see how they can plug into our existing REITs, the Imara I-REIT, and the Sharia I-REIT that is under construction. That way they reduce on their expenses, and of course the time it takes to onboard into an existing REIT and setting up one for yourself would definitely be reduced. So we are hoping that will bring more investors into the REITs fold, and of course a lot of education, especially to the general public. I recently held one such civic education program in Nairobi for the Muslim community. It was very well attended, and when after we were done with the presentation, they were like, "Okay, that thing is very simple. Are you sure, Timothy, it's that simple?" So I explained to them, yeah, it's that simple. So really education out there needs to be really entrenched, and it's going to be expensive, but because if we do it free of charge, but at the end of the day, once you have that knowledge entrenched in the masses, we shall have more private wealth capital coming in and supporting the REIT. In terms of the returns, yes, I think how we can do it, probably look at the expenses that we incur in a REIT. I'm not saying we cap them, but we could look at it so that they can also be attractive. If I do my own rentals, my own mabati houses, the rental yield there is almost 20-30%. Yeah. If I was to put them in a REIT, I add those extra costs, yeah, which would then make the it has to be demonstrated that the value add of putting those assets in a REIT would actually benefit in the long run the investors. Thank you so much. I think I'll stop it there and back to you, moderator. Thank you.
Yeah, so the allocator is simply saying that if we want to mobilize capital, we have to, it's not just about structure, it's return and everything. But Fred, you've allocated capital both as a private equity person and you've mobilized capital, across border and regionally. And importantly, is there merit in having a big REIT that then sits in Nairobi, Dar es Salaam, Uganda, Kigali, or are there barriers in terms of mobilizing capital, especially into REITs regionally, looking at facets like, do we have alignment in terms of governance structures, regulation? Is currency even a big issue? Because would you invest in a cash-denominated REIT in Rwanda, or you have to domicile local currency REITs? So what do we need really to do in terms of trying to, go cross-border in terms of our REITs, in terms of mobilizing this capital, as someone who's done it practically?
Thanks a lot, Matthew. So I think just coming back to the points you've raised previously, I think ultimately it's about, are you delivering a good return? So I think we'll take that as a given. In terms of mobilizing across the markets, again, I'll come back to what you said previously. Real estate is very much a local currency product. So, and beyond that, I think certainly on the real estate side of things, it has tended to be that you are limited to the country in which you are licensed. Yeah. So that has been quite a problem in terms of bringing that capital across markets. However, that said, I do think there are some very good opportunities across the markets, particularly like where Ragav plays in kind of these dollar-denominated assets. I think that is a good place to look at. But ultimately, the governance is not exactly the same. I think in some of the other countries in the region, there might be a bit of it's one in particular, there might be a bit of a view that some outsiders are coming to take over or to dominate what is happening in those markets. But I think the way we're going to do it, we do it here first, so that it works well, and then that will, I think, will really push it. You saw what happened with the NSC over the course of the last 20, 30 years. It's really pushed Uganda and Tanzania, and particularly Rwanda, to really up their game and do better. And then ultimately, the very last thing is that real estate has not really been as institutionalized as it really could be. I, for one, would not consider putting money into any other country unless it's institutional, proper reporting. ESG, I know you say there's no return, but we don't want people dying on our sites. We don't want people in their apartments crashing through the glass and getting hurt. So I think there are some returns. In terms of stuff like, I want the costs to be as manageable as possible. If that means thicker glass on the windows, all the better. And for me personally, where ESG comes in, your thicker glass is safer, but also when you close the window, you can't hear the traffic anymore. So I think there are also some other returns there as well.
No, I mean, very good. Don't hear me. I'm a big proponent of ESG, right? We've paid a lot of school fees for the market, and Jeff knows that. We've done a lot. In fact, he benefited more from the school fees we've paid than anyone else. But part of the school fees also in structuring is asking ourselves, and this is a question that issuers keep asking themselves, I'll structure a product, and I'll structure it for the market. But I have global capital telling me I need political risk insurance in that product. I need guarantee that my money will come back. And this is a question to credit enhancers and guarantee providers like Damana. Does that really, really make a product more attractive out there? Because we know real estate, as Fred has said, is a local currency play, but we are structuring real estate to also attract global capital. But is there room to enhance from a credit guarantee, from a political risk, what MIGA does? And have you seen that, bring a little bit more clarity, a little bit more of at least some uptake from some of your people that you're advising for our products?
The short answer, yes. Think of it like this. You have this vehicle that is supposed to take you somewhere. I'm trying to allude to, let's say, an image. But to fix it up, you need specific tools that just tighten everything up. Think of your wheel jack that tightens your wheel. That's what these tools are. So, for example, you talk about political risk insurance. If you're doing a cross-border thing, you need to keep in mind that these are different jurisdictions. What happens? Let's say we decide we are going to invest in our neighbors, right? What happens if the political favorability changes with regard to investors from this particular location? When you talk about guarantees, most financiers don't like uncertainty and complexity. And when they cannot either understand or feel that they can predict, then they will always say no. So the guarantee just serves to help them make that choice, right? Take that leap of faith, maybe give a better tenor, lower pricing, rather than, saying, okay, I don't understand what you're saying, but I'm willing to do this if you give me this outsized return. So essentially, that's the benefit of those tools. And these tools, you can actually be very innovative with them. There are many things, alluding to a conversation I've had, there are many things that you can actually innovate. Think about, this actually came this morning, so think about guarantees on rental income. You could, if you have tight enough rental clauses or rental or lease agreements, you could actually give your financiers comfort that I have actually locked this person in, right? And that could go a long way in pushing rates as marketable securities that can be invested in. But food for thought, right?
Yeah, but the question that I have is, guarantees work for debt. And this is maybe to the audience as well. Would they work for equity? Because if I have a Muzungu investor, using the local language, next year when the elections and then there's tear gas in CBD, and the rest of us are very calm, saying that's normal, right? And he's supposed to put in equity and he's looking at you, and now he's saying, no, for me to put in equity, I need some guarantees that I'll have my money back. Would that work for equity?
It can. So there are other, unfortunately, I don't know of one in Kenya, but I do know of some in Europe and the States that actually do guarantee equity investments. So it's possible. The challenge there is normally guaranteeing a return. So how do I guarantee what return you'll get? But essentially it is possible. You can structure something like that. Yeah.
Okay. And this is now, let's come to the audience, and we'll give you a chance to ask a few questions. I know we have the graveyard shift before lunch, but I have a few questions to you. All of us are listed in the market, and all of us are trying to get listed either on the sustainability section of the main market. We are sitting on the USP. But the one person we've not really addressed, because we're talking about institutional capital, is a retail guy. And I think the only way for REITs to scale is to tap into retail. Do you agree? Paul, do you agree? Because all these products, we are structuring them for fund managers. This guy has told us about return. How many REITs are giving yield north of 5%, 7%, even on the dollar? But are we seeing more institutional capital coming in? No. Should we then now tap into retail? And is retail going to be a solution in terms of mobilizing local capital for our REITs?
So Matt knows I've expressed a view, so he's putting me on the spot. No, look, I think retail is the ultimate depth, demonstration of the ultimate depth of the market, right? And what I'm suggesting is that new products need to be developed, and they need to deepen, and the track record of the product has to come through over some sort of sustained period of time, and then the natural deepening will come with the retail investors. What I always say is, like, when I think there's all this about democratization, the first form of democratization is for the pension funds, who is the people's money, to local guys, to invest in these products. And then the retail, ultimately, the masses will get exposure to these asset classes. But in my view, it has to be led by institutional investors. And that's the role that our fund managers here, and can I keep and ask one or two questions of our fund managers? So I had two questions, the two Timothys. So Timothy, Gen Africa, you mentioned that a lot of the pension funds, beyond REITs, I know there's a REIT conference, but beyond REITs, a lot of the pension funds have a history of disappointing returns in real estate because they were doing it directly, but not necessarily doing it well, right? It was, on balance sheet and not just. And then you also mentioned that, there's a benefit of having specialized managers, right? So is that something that you are actively marketing to your institutional investors to say, if you want to do real estate well, here are the best-in-class external specialist managers, and here's 3 or 4, and we'd suggest you allocate 25, whatever, the right number, allocation to these 4 or 5 managers. Is that something is that an active conversation that you're having with the pension funds to say, don't make the same mistake you made 10, 15 years ago because you've got all this cash and now you want to deploy it? And then for the other Timothy, CPF is the fund which has the most real estate capability. You've got your development management, property management, you've got laser, now you've got a REIT management license, etc. So, and then you told us, and then you invested in ALP and Acorn, so you've been active. Should we be concerned that you are now bringing in a lot of this internal expertise, and you've already solicited investors to come into your products, which is great, but how are you also trying to balance between you've got your own internal capability versus, as the fund manager, just showing opportunities across the market beyond your internal capacity, giving equal weighting, or what weighting, how do you weight presentation of other managers to your institutional investors beyond your own suite of internal capability? How do you manage that balance? I'm interested in both those questions.
Wagema, you had a question or wanted to contribute so that we can take all of them? Yeah. Okay. Yeah, then we'll take them.
I think the question that Matthew has raised is very valid about the retail play. And why that is key is because it actually demonstrates there'll be more liquidity and all that. However, one has to be very careful. So I wouldn't fault the different REITs if they first choose a strategy to first anchor with the institutional. The reason being, even like for Acorn began as a green bond. They already got the traction with the institutional, and then even the D-REITs were actually the institutional. And then later with the VUCA, they were also able to crowd in there. the retail, and also learning from ILAM. ILAM, one of the biggest issues, it listed on the main market at 20. Again, a lot of retail participation, they're not patient, it actually came and it had to actually now move to the USP. So I think for that reason, it would still be a good strategy to first anchor with the institutional, get that confidence, and then also crowd in gradually and in a tailored way the retail, like what VUCA has done. And also for us in the NSE, we're also keen on having 9 million active retail. And when we have that, the market will truly be vibrant. One of the key takeaways from the KPC issuance is that while the headline said we raised 106 billion, 4 billion was actually mobilized from retail. So that's a strong signal. So that for any person coming to market, we actually have 4 billion in the capability. With the ZD, it actually becomes easier even as we support the entire brokerage ecosystem. So I just a comment to what he was asking, and also just to strengthen the conversation. Thank you.
Thanks, Ogema. The two teams, you have a question. Two questions, rather, to tackle.
Great. Paul, the simple answer is yes, but I know you want a better answer than that. So I'll give you a picture, and it's equivalent. I know you had asked when the trustees here, so I can give you answers that are equivalent to having 100 trustees here. Notwithstanding, I think next time we need to have them here and roast them in their personal capacity, right? But what we're observing, so let me just give you observations. Two things. The legacy issues, I think, are much bigger than we think. And what I've actually seen is, and this includes us, not just outside participants, we overestimate investable capital from the industry as a result of those legacy issues. If you were to quantify them, you would be shocked. Yeah, it's really huge. But what we're seeing over time is a lot of these schemes are in a turnaround phase. And that's why I think promoters that are getting ready, or the ones that are already taken off, will reap big gains in the near future. Tied to that would be some of them already exposed. So you'll find a scheme, if it has exposure to residential, its appetite might then be towards student housing and vice versa. So there are limitations that when you look at the capital base, when you drill it further, you actually realize that what we see as the quantum of investable capital is actually way lower than we actually think it is.
Tim?
Thank you. I think you're spot on. CPF happens to a very aggressive institution. One of the rule of the thumb is that we always listen to everybody who comes to our institution. We listen to their ideas, and then we decide what to make of them. We have a REIT manager license. I don't know if the team is here. Yes, I can see Joanne there. Raise your hand. Part of the REIT management team. They have some very strict targets in terms of making sure the Imara REIT delivers on their mandate in terms of returns, and of course growing the portfolio. So what happens is that once we listen to some opportunities, we normally think, okay, this one is ripe for Imara. So we call them up and tell them, guys, look at this, see if it is good to add it to your portfolio. At the same time, remember, our pension schemes are very independent. They are not, they operate independently of the REIT manager. So for example, when ALP came to us, we've always wanted to be exposed to the warehousing segment, but we didn't know how to go about it. So when they came to us, now we analyze that not as the REIT manager, but the county pension fund. So if it makes sense, there's some good returns expected from that, then the scheme invests. So the distinction is that the REIT manager have their own target. They have to expand their portfolio. They have to give us good returns. But the pension schemes, county pension fund, lab trust, and the rest, they are very, very welcoming to any ideas that we come across, and we analyze them very dependently. And there's never any bad blood between us and capital once we, once we do the investments. Thank you, thank you.
Yeah, just to the audience, just before we just close this out, I have a question to you and any taker here. So we're in a REIT conference, so it's the underlying asset is real estate. So are we real estate guys trying to structure capital markets products? Or are we capital market participants structuring real estate products? Because the conversation on capital, if you walk into pension funds, the reason why they don't allocate is, besides there's a cartel that decides that fixed income and equities is what works. Because to this day, only 2% of pension money, less than 2% of assets under management in this country have gone to REITs, less than. Yet, we are structuring capital markets product. We're saying it's an equity investment delivering fixed income type returns because of the cash flows that you've said that you lend against. But are we structuring wrong because we are not attracting the right capital? Are we structuring wrong? Or is that the capital available in the market is actually looking at us different? Because how much is good return? I don't see any REIT here giving anything less than 8-9%. And that's a very stable return. But are we structuring wrong? I think the question that we have to take out today is, capital is necessary for all of us. And we, like I said, God, data, and capital. That's what is driving real estate in this market. But we all know which one passes investment committee, and that's capital. But I would tend to disagree with you, Brian. All these investors, all these REITs here, first are anchored by institutional, because institutional gives you grounding. And then they have to look at their break-even and then mobilize local capital. And that local capital, in my view, is a very big catalyst in terms of scale. So retail we have to find a way for REITs to mobilize capital locally. Secondly is, we are all, as issuers and promoters, looking for the day when a local REIT will be anchored by a local investor. All the REITs today are anchored by who? Please shout. They are anchored by DFIs. Majority of the REITs are anchored by DFIs. Look at the REITs today. The anchor, go look at the OM. Anchor investor is not a local pension fund. Why? And that's the issue we have, because real estate is a local currency, and that's the takeaway. How do we then get the local pension funds, the insurance companies, to anchor our real estate, our REITs, and not then commercial capital or concessional capital follows? Because all our REITs today, majority are anchored on onset, on listing by who? By DFIs. It's time we mobilize local capital, get those local pension funds to anchor the REITs, then we can have DFIs and commercial capital following through, then later scale using retail. Thanks, everyone. I think we'll hand over the mic, then we can go for lunch.